Good morning, hello, and welcome to today's virtual coffee talk. I'm Margaret, and I will be the web host for today. We have a few housekeeping announcements, and then I will go and introduce our speakers. As a reminder, in order to earn CPE credit for today's session, you must stay connected to the webcast for the entire program and participate by responding to at least 3 of the 5 interactive questions. There will also be a course evaluation, which will open upon exiting the webcast. With that, I'll introduce our speakers. Kevin Jacobs is a managing director with Alvarez & Marsal Tax in Washington, D.C., and the National Tax Office practice leader. He brings more than 15 years of experience in tax matters in both the public and private sector. Howard Steinberg is a seasoned expert in tax and restructuring, serving as managing director and head of global restructuring tax services at Alvarez & Marsal in New York, with a history of leading tax-efficient initiatives at firms like Houlihan Lokey and KPMG. Stephanie Detterding is a managing director on markets and transaction teams at Crux, leading efforts with buyers of transfer credits and leveraging extensive experience in tax credit brokerage, finance, and law. With a CPA and JD, her career spans roles at Twain Financial Partners, EY Legal Practice, specializing in tax and real estate finance. Keith Martin is a renowned tax lawyer at Norton Rose Fulbright with over 25 years of leadership in the firm's project finance group, facilitating large deals, major transactions in the last 4 years. Steve Schmoll is a senior director at Alvarez & Marsal Tax, specializing in comprehensive tax planning for renewable energy development, project financing, and M&A transactions. He holds degrees in finance, law, and tax, and is a member of the Minnesota State Bar. Finally, Nate Jones is a lead product manager with Wolters Kluwer Tax and Accounting. He will be showing us today how to find additional answers and resources using CCH Answer Connect. Thank you for your time with that. Now, Kevin, please take it away.
Great, and thank you, Margaret. Thanks, everyone, for joining us today. We have a jam-packed agenda on what is really a very hot topic, dealing with the transferability of credits and what should a buyer think through in identifying themselves as, hey, I am the right buyer, and this is the credits that I should be buying. We'll be discussing an overview of the energy tax credits as a whole and the state of the market. Obviously, we'd be remiss if we didn't discuss legislative updates. As you know, we had a change in administration. We're all aware of that, and thinking through what does President Trump want to do and what is likely possibly coming out of Congress. Then thinking about the benefits of buying these credits and being a successful buyer, and we'll end with risk mitigation and some of the protections. And then finally, Nate will show us a host of information on CCH Answer Connect. With that, we're going to launch our first polling question, which is, how would you rate your knowledge of energy tax credits? What is an energy tax credit? My nickname is Tax Wizard. Again, please make sure that you answer the polling question so you get credit. Howard, while they're answering the questions, why don't we start talking about giving the audience an overview of energy tax credits?
Thanks, Kevin. So the purchase of a clean energy tax credit can be a very effective tax planning strategy and provide cash flow benefits. Corporate taxpayers across all industries can benefit from the purchase of clean energy tax credits. Perhaps this is why the transferable clean energy tax credit market has experienced tremendous growth in a short period of time. I'm going to turn it over to Steve to provide an overview of the energy tax credit. Steve?
Yeah, thanks, Howard. And I just briefly, I see 3 people have said their nickname is Tax Wizard. So I guess I don't know if that's a compliment or not, but I like that nickname. The overview of energy tax credits. So energy tax credits have been around for a long time. Since the ITC has been around since the late 1970s, at least off and on. And so the idea that energy tax credits started with the Inflation Reduction Act is sometimes tossed around, and that's not necessarily exactly right. Pre-Inflation Reduction Act, there were 2 main tax credits for the generation of energy. The production tax credit, which, as is in its name, is a credit that's generated as a project produces electricity and sells it to a third party. And then the investment tax credit, which, again, like its name, is a credit that's available on the making of an investment in an energy property, generally a property that produces electricity, but there's also biogas, previously energy storage in limited circumstances. They were not transferable or refundable credits, and developers, which is a continuing theme, generally could not use the credits themselves against their own federal cash tax liability. So the market over the last 25, 30 years developed multiple structures to allow developers to benefit from the credits without using them themselves, including the flip partnerships, sale leasebacks, and inverted leases. But then in 2022, Congress passed and Joe Biden signed the Inflation Reduction Act into law. And there are multiple changes to the credit structure under the Inflation Reduction Act. The basics are that for the investment tax credit and the production tax credit, it's not just one rate for your production or for your investment. Your rate depends on multiple factors, including your labor, your on-site labor for the construction of the project, and whether that meets certain labor requirements. You get an adder if the project is located in what's called an energy community. You can get an adder if the project meets domestic content by America requirements. And most importantly for this webcast, the Inflation Reduction Act added transferability for credits. So beginning in 2023, developers can now sell a credit to a third party in exchange for cash in lieu of or as part of one of the more complex structures. So I think the interesting opportunity there is the tax equity flip partnerships are still alive and well. Most of them now have the option to sell the credit, and that is a great place for a buyer who's, especially a new buyer, to test the market, because those projects are usually fully diligenced by tax equity already. A couple of other credits that are very popular under the Inflation Reduction Act, there's 45X, which is a production credit for the manufacturing of solar, wind, or battery technology. That is a enormous credit. Those are trading in 9 figures of credits per year from certain facilities. There's a clean hydrogen credit, which actually kind of has gone nowhere because the rules around that were pretty strict. And then there's the carbon capture and sequestration credit, which has been around since 2008, but it was modified and expanded and is expected to take off over the next 5 to 7 years as the technology matures.
Great, Steve. So we're going to launch our next polling question, which is, how would you rate your company's interest in buying energy tax credits? It has not been considered at all. We've discussed it internally. We're actively pursuing credits, or we have no interest. Howard, while they're filling out the polling question, why don't we start talking about the current state of the energy tax credit market?
Sure. Thanks, Kevin. So, of course, it's important for a prospective tax credit purchaser to understand the market. And I'm going to hand it over to Stephanie, who will address the current state of the market, including the size of the market, types of credits available, and pricing considerations. Stephanie?
Yeah, thanks, Howard. So as Steve talked about, the IRA provided for transferability starting in 2023. And as he also mentioned, a lot of the ways that investors were monetizing the tax credits kind of pre-IRA was through partnership structures. And they were, at the beginning, developers in 2023 were still utilizing those kind of pre-IRA structures. And in 2023, we saw the back half of that year really take off with transfer credits. And I think we saw about 7 to 9 billion of transfers done in 2023. Fast forward, and 2024 really is kind of the first full year of transferability. And the market just grew exponentially. So based on our data, we believe about 52 billion of tax credits transacted. And the structures that Steve talked about, kind of I'll just throw into the bucket of like tax equity structures. That market has traditionally been about 20 billion or so. And through the IRA, we saw modifications, or what people refer to as hybrid structures, where partnerships were actually still utilizing the transfer credit provisions to transfer credits out of the structures. And so ultimately, our data showed that there were about 30 billion or so of transfer credit transacted in 2024, which is just significant. And that's what this chart is showing here. The other thing that we observed, which I think is part of the IRA and what it was intending, is that traditionally investors and buyers early in 24 were focused on the traditional technologies, wind, solar, storage. But as you can see here, as the year progressed and throughout 2024, you see new technologies starting to transact, and really the split was pretty even between the investment tax credit and the production tax credit. Other things that were interesting that we found in the data. So about 72% of the credits transacted in the second half of 2024 were new technologies. So I mentioned kind of solar, wind, storage were the predominant technologies in the first half of the year. We saw a shift there. 51% of the credits transacted in the second half of 2024 were 45X. So that is a new credit. It's the advanced manufacturing credit. It is a production tax credit. We saw a lot of first-time buyers choosing to start with that credit. And so it became a significant part of the supply and what we saw transacting. Right now in Q1 of 2025, when we look back to kind of Q1 of 24, we are also seeing a shift now that buyers are continuing to look at those new technologies as well. And then this slide just gets into pricing and how we saw pricing play out in 2024 compared to 23. So average pricing did go up slightly for the investment tax credit. On average, we saw it go from 92 cents to 92.5 cents. And we also saw the production tax credit pricing go up 95 cents on average compared to 94 cents. With this chart, a few things that I would highlight. This pricing is gross pricing, so it's the pricing that we would expect a buyer to pay to a seller. Typically, we see that sellers are covering the cost of insurance, typically legal fees / due diligence fees up to a negotiated cap and other transaction costs. You can see here that across all size ranges, the production tax credit, given kind of the risk profile of that credit, it does tend to price at a premium compared to the investment tax credit. You'll also see that as the size of the credit transaction increases, pricing tends to increase. And I always get questions about this from buyers. And I think a few things are necessary to note. I think as you get into the larger transactions, typically the counterparties, the sellers on the other side are going to be investment grade or large, sophisticated, have a strong balance sheet, and therefore they can command premium pricing. I also think that there tends to be a lot of competition on the larger credits, so supply and demand dynamics do play out there. And then lastly, I would say, as you're talking about hundreds of millions of dollars of a credit purchase, even at a 95-cent price, that can still be real dollar savings that are very meaningful to a buyer, even if the discount maybe is not as large as it would be in some of the smaller tax credit sizes.
And then I guess real quick, Stephanie, on the 45X credit, to your point, we see that as a tax credit for people who like to take their first step for a couple of reasons. One is that it's very easy to compute. You know how many components you sell and produce. you don't have the labor requirements, you don't have the energy, community, and domestic content adders that get you there, and there's no recapture considerations for after the fact credit, having the credit go away after the fact. So we really do see that the 45X is a very popular credit for new entrants, and it usually does price towards the higher end of this chart.
Yes.
Thanks, Stephanie. So, look, President Trump has talked about repealing the Inflation Reduction Act. President Trump has also focused on an energy dominance agenda. Clean energy arguably can help with energy dominance. We note that much of the financial benefits of clean energy tax credits have flowed to Republican districts. And we hear Republican congressmen publicly supporting clean energy tax credits. So this is a complicated and confusing political situation. So I'm going to turn it over to Keith. Keith, can you please provide a legislative update?
Sure, happy to do that. Congress is in recess this week. I'm in Washington. It comes back next week. As Howard said, Trump and the Republicans talked during the last campaign about ripping the Inflation Reduction Act root and branch. They have razor thin margins in the House and Senate, so there's a limit to what they can do. The only one bill a year, a fiscal year, can pass the Senate by a majority vote. The Republicans can lose only 3 senators and still pass something. In the House, they have about a 3-vote margin as well. So it's telling, as Howard said, there was a letter from 21 House Republicans urging the House Tax Committee chairman not to take a sledgehammer to the Inflation Reduction Act. And in the Senate side, there was a similar letter from 4 senators, just one more needed than is needed to block action. However, if you look at the letters, they look like letters written to try to get a bunch of people who don't agree on specifics to sign. So there's a limit to how much comfort one should take in them. They're better than not having them. The state of play is the following. That one bill that will pass this year will be a massive bill that contains a lot of the Trump program. It's called the Budget Reconciliation Bill. It is a multi-step process to put it through Congress. The first step is for the 2 houses, House and Senate, to agree on top line numbers. They got off to a rocky start. They started in February with very different top line numbers. And by the end of March, or early April, when Congress left on recess, they couldn't come to agreement. So they just agreed to disagree, basically, and try to move to stage 2 of the reconciliation process, where the congressional committees actually try to hammer out the details. There's a May 9 deadline for the congressional committees to have hammered out the details. The word on the street here in Washington is the tax writing committee in the House, at least, is behind schedule, probably won't hold a markup that's a vote on the details until sometime in mid-May. The date is significant because that's when we'll get our first look at what's likely to be in any rollback. Among the other things that were punted when the House and Senate couldn't agree on top line numbers is the Senate wants to assume that extending 2017 expiring tax cuts will have no loss of revenue to the federal government. The House is not so enamored with that. The Senate parliamentarian will have to decide whether that's a fair assumption when the reconciliation bill gets to the floor. Timing on this, the House would like to resolve everything by Memorial Day. Most people think August or September is more realistic. There have been the House tax writing members on the Republican side and also the Senate have been meeting privately, but not taking very many decisions at this point, just hearing from staff and then holding up cards, red, green, or yellow, just to try to give the chairman a sense of what might clear. But very few leaks of what's in that bill, almost none about the Inflation Reduction Act. The last thing I'll mention, then I want to turn it over to Stephanie, is we are seeing lots of companies rush to start construction of projects this year. Many rushed last year. in the hope that they will be grandfathered for any rollback of tax credits. They're betting on what Congress ultimately does and also how any transition rules are structured. In 1986, when Congress last rolled back the investment tax credit, it grandfathered anyone whose project was under a binding construction contract, a binding offtake contract to sell the electricity, or also where the developer had incurred at least 5% of the total project cost. There were also 28 pages of one-off transition rules called rifle shots for individual projects, where the Joint Committee on Taxation staff felt it was unfair to pull away the incentives given how far advanced those projects were. So, Stephanie, what would you add to what I just said?
Keith, I think you covered quite a bit. I think the only other thing that I would maybe add, because it does come up a lot, is risk of retroactive change in law. And I think we believe that that is theoretical at best. We don't, see that being mentioned in any of the bill reconciliations, but it is something that comes up with all of my buyers transacting and how they are maybe covered for that potential risk, even if like I said, we do think it is theoretical. I don't know, Keith, if you have anything else to add there on that point.
Well, having been around Washington, I was on Capitol Hill on the Finance Committee staff and then doing this for 42 years. If you started construction last year, then it's hard to see how Congress can do anything to roll back the tax credits for those projects. Those are insulated from tax law change. The people who are starting this year for the new technology neutral credits, a little bit more risk there. There's a Federchak bill that Julie Federchak, the Republican Congresswoman, former utility commissioner from North Dakota, has introduced with 3 co-sponsors, none of them on the Tax Rating Committee in the House, but it would roll back, phase out over 5 years production tax credits on operating projects. These are the new technology neutral ones. So it's something to keep an eye on, but you're right. Historically, Congress has not held out an incentive for people to do something and then pulled it away after they've already done it.
It is, Keith, just to chime in, it is interesting to note, right? I mean, President Trump and the administration has publicly come out, as you noted, and said, or suggested, I want to say, that, we're going to kibosh the IRA or do something to roll it back. I mean, I'm following a lot of what's going on in the policy, and there's also some people that are saying, well, maybe they're trying to make a way of evening the playing field, which could also be a matter of providing other credits to the non-green energy space, so that way incentivize that production as well. So you could start thinking of like production credits or something in the oil and gas space as opposed to a rollback. So it's going to be, to your point, there's a lot of math and games that are going to be played, including, current policy versus current law and so forth. But it is something that we're all waiting for in bated breath.
Anybody who did something last year
year.
is pretty well insulated. But if you're doing something this year, there's a little bit more risk.
And Keith, do you see credit buyers taking change of law risk? Is that something that a credit buyer needs to worry about too much?
What we see is credit buyers getting a refund if the seller doesn't have the credit to sell at the end of the day.
Yeah, and that's consistent with what we see, and it's probably worth highlighting here that typically a buyer of tax credits, whether it's the production tax credit or the investment tax credit, is not actually paying for the credit until after it is produced or generated. So after placement in service for an investment tax credit. And I think in every deal that we've done, a condition for payment is that there's no change in law. I think where a lot of the negotiation happens is how change in law is defined, or if a proposed change in law is also brought in as a condition. Want to highlight this slide. We also are monitoring kind of legislative updates regularly, but also we see buyer activity continuing, and it's been strong since the election in November, and actually Q1 activity of 25 is more than Q1 of 2024. So there are a number of protections for buyers to transact, but it is something that is top of mind for them. I know on the next slide, we also did a poll of kind of what's most important to them, and they are looking for, regulatory legislative certainty on transacting. I mentioned the popularity of the 45X credit. We really saw that credit transact more frequently once final guidance came out for it. And I think right now, even in my day-to-day discussions with buyers tend to be, what technologies are maybe safer than others as far as being impacted by legislation, or, if I buy a 24 credit, is that at more risk than a 25 credit, and the various protections that they can get when transacting. Keith, Steve, I don't know if there's anything else that you would add there.
That's a good point. People do pay after the fact, so that is significant protection.
We're going to launch the next polling question of how does legislative uncertainty impact your ability to transact? One other thing I'll just note is obviously the administration has directed the agencies to review regulations and determine which regulations they want to pull for one reason or another. And so, Stephanie just alluded to final guidance. Who knows if some of the guidance in this space is going to be identified to be pulled. It's yet to be seen. But, Howard, while we're thinking through, the legislative uncertainty, why don't we focus on the benefits that a purchaser has and how to maximize value? So what should they know?
Yeah, thanks, Kevin. So as I mentioned in my opening comments, the potential benefits to a buyer of a clean energy, transferable clean energy tax credit can be significant. Again, ranging from, as mentioned, permanent cash tax benefit, cash flow benefits, potentially financial statement benefit. So I'm going to turn it over to Stephanie to discuss in detail the benefits of the credit purchase.
Yeah, and Steve, did you want to kick us off maybe, and then I can chime in?
Yeah, I'll jump in. So thanks, Howard.
Sure.
So the benefit obviously is that instead of sending $1 to the IRS and the Treasury Department, you can send 92 cents, we'll use as our stalking horse, to a third party, and then use the credit you purchased from the third party as a substitute for your cash tax payment. The first step, of course, is understanding exactly how much federal cash tax you owe in a certain year. And the key to remember for the credits that are transferable is that they can only offset roughly 75% of your end of the day cash tax liability, which is after using NOLs and after using your foreign tax credit. So that's the basic capacity calculation. There are some complications if you are a BEAT taxpayer. There are some potential complications if you are a Pillar 2 or not considering if Pillar 2 were to come into effect in the United States in full. But I mean, the most basic value proposition is your discount to fair market value. So you're paying less on the dollar. You can also gain a benefit to yourself or a benefit to the seller, depending on your relative costs of capital on when you make those payments. So the rules are pretty flexible on when the cash can move. If a credit is generated in 2025, the cash can move from the buyer to the seller beginning January, assuming calendar years, beginning January 1st of 2025, and then all the way into September of 2026. So if there's a cost of capital arbitrage between the two players, there could be spaces where it makes sense to accelerate those cash payments or defer those cash payments. And then Stephanie's going to get into the next two pieces, but just real quick, one other component that we have seen in the market is it's very important to have a clean deal to maximize your value and to not have a deal fall through. I think that a lot of credit sellers have found that going for that top dollar, that top line 96, 97 cents, might not be as valuable from somebody who may be iffy on committing as someone who's willing to give you 95 cents and is rock solid on closing in 30 days. And so that's also a part of maximizing your value, is making sure that you are the best profile to a credit seller.
Yeah, agree with all of that. And the other thing I would highlight on the payment, as I mentioned, kind of there is industry standard around when you typically are paying for an investment tax credit and a production tax credit, but those are negotiated commercial points. We do see buyers who want to hold on to cash longer, negotiate for that. And where we typically see that payout is through pricing. And so if you want to hold on to your cash longer, it may mean that you are going to pay a little more per credit to do so. Other economic benefits for buyers is the ability to reduce your quarterly estimated payments. Here, I would say that this is going to be buyer specific, and you want to look at how you calculate your estimated payments if you are going through kind of the safe harbor process and you don't want to be underpaid. But, if you have, let's say, a term sheet or an executed TCTA, it's not defined on what you actually have to have. And I have known buyers who have neither an executed term sheet or a transfer credit purchase agreement executed, but know that they are going to purchase credits in a year, begin to reduce their estimated payments for a tax credit that they are going to purchase. So kind of breaking that down and walking through some high level examples. For a production tax credit, let's say that you purchase $100 million and you are going to pay for those quarterly, $25 million. Typically, we see that play out that the buyer would, in lieu of paying the IRS their quarterly estimated tax payments, they would be paying the seller a discounted price on a quarterly basis, but they would not be paying the IRS for those estimated tax payments. For an investment tax credit, because that is going to be paid at a specific point in time, placement in service. If you had a transaction that you knew would place in service in October, but you had a documented term sheet, transfer credit agreement, and you knew you were going to purchase it, depending on your circumstances, you may start taking that credit into account on your quarterly estimated payments when you actually enter into that agreement and know that you're going to take that credit. So there is some flexibility around the quarterly estimates and the ability to reduce your cash payments prior to actually paying for the credit. And then multi-year tax planning, we do see a lot of buyers, especially the experienced buyers, entering into multi-year agreements, especially the ones who have reliable taxable income and know that they're going to have a certain liability year over year. There's a lot of efficiencies to be gained. You can likely get a discount on future pricing. And so that is something that, buyers who maybe are a little more savvy are starting to do. And then lastly, I would just highlight that under the IRA, you can actually carry these credits back 3 years and carry them forward 22 years. We've had a handful of buyers go through the carryback process and looking to carry back the credits 3 years. And so buyers who maybe want to buy more credits in a year actually look at their prior 3-year liability and make a purchase accordingly. There is an analysis around when the buyer is going to actually pay the seller for those credits and then when they would be able to get a refund from the IRS. And so that is part of the analysis and if it is worthwhile for them to carry back, but something definitely worth highlighting.
Great, thanks, Stephanie. And so we're going to launch our next polling question, which is, what is the biggest impediment to buying energy tax credits? Is it lack of energy industry knowledge, inexperience with tax credits, potential tax reform risk, or cost of capital versus potential savings? And, Howard, while they're answering that question, why don't we try to help identify what it means to be a successful buyer?
Thanks, Kevin. So what does it take to be a successful buyer? Not very different than any transaction. Preparation and execution are critical. So I'm going to turn it over to Stephanie to discuss in detail what it takes to be a successful buyer in this market. Stephanie?
Yeah. So I think for the first time in my career, this is the most influx of kind of new first-time participants, new buyers into the industry. And that's been really exciting, but it also means that this is their first time transacting. There's a learning curve, and depending on the buyer, there may be multiple layers of internal approvals that they have to go through. Depending on the size of the credit that's being purchased, they may need board approval. There's internal education that needs to happen. And so what we see and where we help is really, that internal approval process. Like I said, it's going to be different by buyer, but it can take 1 to 4 months depending on what your company internal approvals look like. Once you actually have approval to transact, we find that transactions can move fairly quickly. We talked about the production tax credit, and as Steve mentioned, the 45X credit is a simpler transaction. It's easier to diligence. We would say on average, we see those deals close 6 to 8 weeks. And for an investment tax credit, on average, we would say, 12 weeks, maybe on the longer end can go 4 to 5 months. But the longest lead time item is getting those internal approvals. And so I would say that if you are the point person at the buyer who wants to maybe start purchasing credits, it's probably worthwhile to figure out who needs to sign off on the credit purchase, what types of credits you are going to be able to purchase. I've seen some buyers, in order to maybe not go through all their internal approvals or be able to transact more quickly, choose to purchase smaller credits where they don't have to get all the necessary layers of approval to at least get one credit done, see how that credit performs, and then find that it's easier to go back and get kind of approval for larger credits. But that is where we find that the bulk of the time is spent. Curious, Keith, Steve, if you guys see that similarly or where you guys are spending the most time.
It's interesting. We don't see that approval process. It's behind the screen from us. So the longest lead time for us is not very long. It's negotiating the tax credit transfer agreement. There are a few documents here, so it can move quickly. Maybe it's populating the diligence site so the buyer can do diligence.
Yeah. So on this slide, kind of the prepare, I would put in that 1 to 4 month time period. I think there is, like I said, a significant amount of time on internal education. So what are the risks that a buyer is willing to take on? What pricing are they willing to accept? Do they want to do multiple smaller credits to offset their tax liability, or do they want to just focus on a couple larger transactions? Your legal and tax advisors. I think it is key to choosing parties that are experienced in tax credits. I think where we've seen transactions go awry, it's been where buyers are utilizing legal counsel or tax advisors who maybe are not renewable tax credit experts. So I think that is very important, and we are always trying to steer buyers accordingly. There's a sample slide here that you'll have, but we also coach buyers to try to put together like a investment guideline or a policy so that they have the parameters by which they can transact. It just makes it easier rather than kind of going back through. And then I think getting comfortable with the documentation around the transfer credits. The documentation is much simpler than it was under the tax equity structures. And so having kind of form term sheets, form documentation is helpful and is going to help you go more quickly. We also do recommend to buyers to look at a few credits, compare the credits, meet a few sellers, figure out which one is the best fit, and down select from there. And if you have your internal approvals and you kind of know what you're looking for, you should be able to go through a quick decision-making process.
And Stephanie, I would just say this: as our viewers look at these slides and see term sheets and diligence and data rooms and contracts, they may think, well, this looks like it's a regular way M&A, acquisition of a business, all those complexities. Of course, the purchase of a credit, much shorter timeline, much simpler process. Just something I want to put out to you, Keith, Steve, to address, so that the viewers understand kind of the differences of not all transactions involve the same processes and timeline, right?
I agree with Stephanie. Tax equity financing,
Yeah.
which was how these credits were passed around in the past, is usually a 5-month process. Here we're talking 6 weeks, 2 months in the typical case.
Very good. Yep. Stephanie, I'll let you keep going. Yep.
Yeah, and I don't have to go through this entire slide, but we put this together because typically for the transfer credit purchases, we are talking with the tax group at a buyer. And these aren't necessarily deal people or the people that maybe would be running deals for the entity that you're talking to. And so we thought it was worth actually talking about how to successfully run a deal. Keith, I'm sure a lot of this will look familiar to you, but using due diligence checklists, there are certain diligence items that you should expect to see on a production tax credit, on an investment tax credit transaction. It will be specific, depending on the technology. It's great if parties can align on a closing date, right? So seller may have a closing date, buyer may have a closing date. I think all parties need to kind of figure out time-wise when they actually want to close the transaction, when they're going to pay for credit. We find weekly calls really helpful to hold everyone accountable, make sure things are moving accordingly. We talked about the legal documentation and internal approvals, and then I think just obviously being responsive to the deal is important. Kind of once you commit, you have a signed term sheet and have a closing date, it's important to move forward with that. Curious, Keith or Steve, if you guys have anything else that you would highlight that you've seen buyers do well during the closing process.
I've seen sellers do things not well, which is the buyer's counsel wants to wait to due diligence until all the documents are there rather than have them dribble out. It's very expensive. Otherwise, Stephanie, it's a pretty comprehensive list you have.
And then the thing that I would highlight here that I think is important is we did observe seasonality trends, really specifically for the investment tax credit. For the production tax credit, kind of pricing rose throughout 2024. But what I have been highlighting to buyers right now is that supply and demand is what drives pricing for these credits typically. In the beginning of a tax year, not all buyers know their tax liability. We still have first-time buyers who have not transacted, who have now gotten approval, and they're looking to transact. And so right now, especially in Q1 of 25, we would have said that supply of credits outweighs demand. We expect that to shift, similar to what happened in the second half of 2024. And that will mean that pricing will go up for the investment tax credit and the production tax credit. It will also mean that the type of credit that you maybe want to transact on is not as available. And so what we are coaching buyers on right now is that if you can get into the market now in 2025, you should. It doesn't mean you have to pay now, but you should start looking at credits now, because you will have more time to figure out the credit that you want. It's possible that you also get better pricing if you're willing to commit now. As Steve mentioned, you can actually buy credits past the tax year in which they're generated. So we have a handful of 2024 credits that are still available that are being, bought and sold in 2025. Our data was that, for every $1 of 2024 credit available in 2025, demand was $5. So I highlight that to say, like, if you can project out your tax liability, if you are able to transact now, you're better off. You are going to have more time, more supply, better pricing.
Okay. Thanks, Stephanie. So as with most transactions, in this case, the purchase of a tax credit, there are risks that the buyer needs to manage. Given the rapid growth of this market, with buyers ranging from Fortune 50 companies to middle market corporations, it's apparent that buyers have navigated the risks in order to successfully transact. I'm going to turn it over to Keith to discuss risk management and protections. Keith?
Sure. So there are four main ways buyers protect themselves. Number one is they get an all events indemnity from the seller. That means if the tax credits aren't there for any reason, they're adjusted, the seller pays. And the seller not only pays the tax liability for which the buyer is now exposed, but also any interest, penalties, and contest costs. The seller oftentimes is required by the buyer to buy tax insurance. Tax insurance will cover whatever you say in the policy you want it to cover. It costs about 2 to 3% of the maximum potential payout. A good rule of thumb is the seller buys 125% of the potential tax liability that it's worried about. In addition, many of the sellers are tax equity partnerships, and there's a third prong of this protection, which is any cash that would go to the sponsor, the developer of the project, can sometimes be swept and help to pay anything that's owed to the tax credit buyer. Second thing buyers do is they do diligence. When this market first started in 2023, people were doing lots and lots of diligence. But over time, they've been doing less and less as they become more focused on what really matters. Probably the biggest risk for buyers of investment tax credits is that the seller inflated the tax basis on which it calculated the tax credit. People bring in appraisers. You have to take a look at the appraisal to make sure it's a credible discussion. Third thing people do is some buyers ask their counsel for a tax opinion. This makes the counsel for the buyer be a lot more focused if he or she has to put the firm's reputation on the line by writing an opinion about the tax credits. In addition, if there's tax insurance, the sponsor's counsel, that's usually on the seller's side, has to write a memo to the insurers, if not an opinion, about the tax benefits. And then the last thing is contractual protections. There are conditions precedent, they're called, it's a legal term, conditions before the buyer has to pay. One of the conditions is there hasn't been a material adverse change in tax law that calls into question whether the buyer will be able to claim the tax credits and the seller sell them. So as Stephanie and I mentioned earlier, the typical protection for a buyer on change in tax law is not having to fund, but if you have funded and a change is retroactive, you get your money back. The thing that people have been concerned about lately is with Trump putting so much sand in the gears of the federal government. We've had 4 acting IRS commissioners in the space of 8 weeks. There's a concern that people will not be able to get a number from the Treasury to register the tax credit sale. You have to have that number in order to have a valid transfer. So we're starting to see in documents people also asking, buyers also asking for their money back if the number isn't given in time. Turn to the next slide. Okay, common mistakes. We're seeing 2 common mistakes made by sellers. One is more typical, where sellers are selling production tax credits, which are taken on the output over the year. Sometimes sellers unwittingly change the tax classification of entities in the ownership chain, with the result that they end up with the wrong entity selling the tax credits, and they've had the wrong entity register the transaction on the IRS portal. The other common mistake we're seeing is that for investment tax credit deals, if the entity selling is a pass-through entity with individuals as some of the owners, it may not be able to sell all the tax credits, at least the ones that would otherwise be allocated to the individuals. Closely held C corporations also in that category. If you have some of them as shareholders, those are small corporations with 5 or fewer individuals owning more than half the stock. So Stephanie, what would you add?
The IRS registration is a topic that is definitely coming up on our deals as well. I think you covered it. I think that the thing that I would highlight here for buyers is that we talked about the pricing discounts, and I think they're attractive, but they're not significant. And the pricing discounts that buyers are getting is not enough for buyers to take on any sort of significant risk. And so I think these deals have really been structured to mitigate almost all risk on of the transaction. And I think we'll talk about on the next slide, but insurance has just become so prevalent on the deals, especially the investment tax credit, because I don't think buyers are willing to take on much risk.
And Stephanie, the insurance, I mean, there's now a well-established insurance market, right? So this is something that buyers could look to, and it's very much part of the ecosystem of these credits, right?
It absolutely is. So I think our data was that 75% of investment tax credits in 2024 had some form of insurance on them, and the deals that don't have insurance, I think, fall into 2 categories. I would say the first is that the sponsor's investment grade or has a really strong financial wherewithal, right? So the buyer can get comfortable if something goes wrong, the buyer can pay them and make them whole. I think the other category is smaller deals, right, where the cost of insurance just doesn't work for a seller, and so a buyer is pricing in the risk profile. But otherwise, yes, insurance is very, very common on the investment tax credit. It shows up on, I think, like 20% of the production tax credit deals, so much less, and usually not wind production tax credits. It's usually the 45X that we see it on, and I think that has to do with maybe the seller's financial wherewithal, but even on that, we are seeing insurance on production tax credit deals less and less, just because of the risk profile and the amount of diligence and verification that can be done upfront on the production tax credit.
Yep.
Well, I want to take this opportunity to thank my fellow panelists for joining us and giving us the insights. Nate, I know that Answer Connect always has insightful information for the audience, and so what information should the audience know about how to use Answer Connect in order to get more information on energy tax credits?
Yeah, it's a great question, Kevin. And again, thank you all to the panel for the great discussion today. It was very, very enlightening. So what I want to do now is kind of transition over into, after you listen to the great discussion that we had today and say you wanted to actually go maybe revisit this topic down the line when you maybe actually have an energy credit deal, how could you use CCH Answer Connect to kind of help kickstart that process again? And what I'm going to walk through now is basically, hey, maybe you're in the context of revisiting this topic like a month, 2 months, a few weeks down the line, whatever. So if you come into CCH Answer Connect, we have up here on the screen, I would suggest just by start by just asking the simple question of what are business energy tax credits? And just ask that question into Answer Connect. And inside of CCH Answer Connect, we've embedded generative AI that basically answers these questions from the trusted content sets that we have inside of CCH Answer Connect. So you can see we have a high-level overview here of what business energy tax credits are. And maybe from here, I want to ask the question of, why would somebody buy a business energy tax credit again? So why would someone buy a business energy tax credit? As a follow-up question to that initial one. So if we ask that as a follow-up question with our conversational AI and CCH Answer Connect, you have your initial question that pops in over here on the right-hand side of the screen. And as we scroll down, the follow-up question comes in, and you can kind of almost have a conversation with Answer Connect the same way that you were discussing, or the same way that you might be able to discuss this question with one of the experts on the panel here. So this just kind of talks about how if you have excess tax liabilities as a corporation or another type of a buyer, you could potentially purchase a business tax or an energy tax credit to offset those tax liabilities. So then maybe you want to go through and say, hey, can you give me an example, question mark, and then include the compliance requirements for both the buyer and the seller, because maybe you want to kind of understand like what are the mechanics of what you have to do with your return to actually like claim the credit. So ask that to CCH Answer Connect, and it'll go ahead and give you an example here that you can walk through. So we won't take the time to read this whole thing on the screen here, but if you did have a company that had a $100,000 worth of credits that it was looking to pass on from an investment in a solar project, this is what you would do on both the buy side and the sell side. So we have the seller side requirements here, and then we have the buyer side requirements down there, as well as just some overall notes on what you'd want to do to make sure that you have the transfer being done underneath all of the applicable IRS regulations. And then if you wanted to revisit the question around, how does this impact estimated tax payments? When can I start adjusting my payments? You can ask that as a follow-up question again as well. And again, based on the trusted contents that we have inside of CCH Answer Connect, you can get these questions answered pretty quickly, pretty easily, just to kind of help re-jog your memory from the discussion that we had for today. Same thing with the can you carry a credit back? If you wanted to follow up on that question, again, same thing, ask the question, and again, CCH Answer Connect will give you the answers where this comes from. And then if you wanted to kind of bring all this together with a quick memo to the file, you could also ask it to summarize this conversation as a memo to the file, and then maybe please include primary source citations in line when you draft it. So put that in, and then it'll go through and kind of take the all of the questions that you had been talking about and the answers, and then kind of summarize all of that back together again in a memo. You can obviously tweak this and adjust it, export it to Word, what have you, and then you're kind of off to the races with at least a preliminary set of research that you can use to kind of butt up against whatever transaction that you're actually looking at, to make sure that you're following all of the steps and requirements that you need to, and you've got this handy to go for the file with just just by asking a few questions and typing a few things into your keyboard. So pretty easy to do. And then if you wanted to see where are the sources inside of CCH Answer Connect that all of this content came from, those sources are all listed at the bottom of every chat in here. So if I wanted to click on our topic page about business energy tax credits, I'll go ahead and click on that. And that should transition us over into the business energy credit topic here. You can see which member of our editorial team keeps this maintained. And then you can kind of scroll through and read this. We typically structure all of our content pages or our topic pages in a, what I describe as like a Wikipedia style overview, where it's written in a little bit more plain language than what you would get if you were just reading the, the code or the text of the law directly. And then we have it kind of nicely broken out. And this is true of all of our topics pages, broken out into the different subtopics along the way. And then the part of this that I will leave you with is potentially maybe you wanted to look at, what's the state tax applicability or the state tax alternatives for some of these tax credits. We have a built-in state tax smart chart that you can use to quickly go through and assess essentially how basically not just the business energy tax credit, but all tax credits are handled across the different states. And you can use the smart chart to see if there's an opportunity to maybe, get a double tax benefit from one of the credits, because not only do you get a federal credit, but there's also a state credit potentially out there as well. So that is what we have inside of CCH Answer Connect. I know we're tight on time here, so I will transition back over to the moderator so we can go ahead and get the session closed out. But thank you all for your time. Very much appreciate it.
Thank you, everyone. That wraps up today's webinar. I want to thank all of our speakers as well as our attendees for their participation. As a reminder, CPE credit will be posted within 2 to 4 business days. You will receive an email with a link to the course evaluation as well as a certificate of completion. The webinar has been recorded and that will be in the email as well. Thank you for attending. And as a reminder, if you would like to learn more about CCH Answer Connect, please fill out this poll. I also left my email in the chat if you would like to directly contact me for more information, future demos, a specific question about the tools and tricks. Obviously, Nate gave a great overview today. If there's anything in more detail you'd like to know, our information is also in the slides. So please reach out if you'd like to learn more. And yeah, thank you all again.